And welcome to another episode of Empowered Divorce Decisions, where we share information and resources to help you feel empowered to make those critical decisions in your divorce and move forward to your next chapter with confidence. I'm Elina Cannon. I'm a private wealth advisor and divorce financial planner at Argent Bridge Advisors. And today we have a very special guest, Graham Pruitt. He's here to share and discuss mortgage options that are available in divorce. Graham is a certified divorce lending professional with Alcova here in Northern Virginia. Hey, Graham.
Hey, what's going on, Elina? Thanks for having me. I really appreciate it. So, pull my screen up here. So like Elina said, I am a certified divorce lending professional. I've been in the business for about 15 years, serving clients in the Northern Virginia, DC, Maryland, Virginia market for a while. And about 5 years ago, I realized that there was a very big need in the divorce space for, divorce mortgage guidance. And so I went out and I got a couple certifications, and it's really helped with knowing how to talk to people that are going through a divorce and really giving them the best options that are available. So I'm excited.
Well, we really appreciate you being with us here today. In divorce, the biggest financial decision tends to be the marital home. Right. I know it definitely was in my own divorce. And then also tied to the marital home is there's usually a mortgage.
Right.
So let's just kick it off. Can we essentially walk through a situation where there's a marital home with a mortgage, both spouses are on the mortgage, one of the spouses wants to stay in the home. So what essentially is what are the options for that spouse that wants to stay in the home? Can they stay in the home and keep the mortgage and just essentially kick the other spouse off the mortgage? Do they have to refinance? What are the options?
Yeah. Well, there's a few options. I think the first option would be to simply stay in the home and continue to, obviously raise the family and be there. And whether or not that person's making the mortgage payment or the ex-spouse is making the mortgage payment, that's option number one, right? Option number two is you can try to assume the loan from the other spouse, which can be difficult in some cases. Mm-hmm. We were talking about this, even though you're assuming the loan, and let's say it's a conventional loan, you're not guaranteed the same terms on the loan. Okay. So, and then the third option is really going to be doing an equity buyout or just simply refinancing the ex-spouse off of the loan. And in that process, you really have to be able to qualify, go through the qualifying process and qualify for whatever the mortgage payment would be on that refinance, taking over that mortgage.
Yeah, so thank you for walking us through it and clarifying. When rates increase, so where rates are today, essentially in late 2023, they're pretty elevated compared to where they were a couple of years ago. So the refinancing seems a little bit less attractive. The assumption of the mortgage seems pretty attractive. But can you tell us a little bit more about assuming like a mortgage, or how do you find out if your mortgage is assumable? And like, how do you qualify to assume a mortgage?
Yeah, absolutely. So assuming a loan is it's almost like getting a mortgage without assuming it. So if you have a mortgage on the house, the first thing you should do is call the company that holds the mortgage, tell them the situation and say, hey, listen, I'm going through a divorce. I want to talk to somebody about how I can assume the mortgage. And they have a whole separate department for that. So you'd get sent over there. From what I understand right now, the process can take a little while. They're not exactly excited to allow somebody to continue to pay on a mortgage that's at 3% versus doing another loan that's at 7.5%. So for them, they're not really motivated to be doing that really quickly. So just know that even if you do assume a loan, unless it's a VA loan, which if you're allowed to assume a VA loan, you'd get the same terms, or an FHA loan, you'd get the same terms. But on a conventional loan, a lot of times they say they aren't assumable, but you always want to call and just make sure. And even though if they do allow you to assume it, you probably are not going to be able to assume it at the same terms. They may ask you to put some more money down. They may say, well, you can assume it, but we're going to give you a 6.5 or 7% interest rate. So it doesn't always work out in your favor on the assumption side.
Gotcha. What about jumbo loans? Is the
Mhm.
best thing just to call the mortgage
It's the same
servicer?
thing. Yeah, you got to call the servicer because they're the ones that make that decision.
Yeah,
Some of them may not want to do an assumption at all, and some of
yeah.
them may be willing to work with you. So I wouldn't, even if you see the paperwork and it says this loan is not assumable, you can always call. It's always an option.
Gotcha. That makes sense. And so if the mortgage is not assumable, then can you tell us, essentially walk through
Mhm.
what is the typical timeline to qualify to, if you have to refinance the mortgage, to refinance that mortgage?
Sure.
First to qualify, and then like what's the timeline
Mhm.
to for the process to actually refinance and close the
Yeah.
new mortgage?
Yeah, absolutely. So the process is pretty simple. There's not a whole lot to it. I mean, if you're working and you have an income, we would take a look at that. We would want to know what the value of the house is and what you owe on the mortgage. And so, based off of what you owe currently, if we were just going to refinance that loan and not take any cash out to pay the other person off, we would simply look at what the payment would be at current interest rates versus what your income is and other debts, and we would qualify you that way. So that process literally can just, we can knock that out in about 10 minutes. And then from start to finish, once an application is completed, it's about 30 days or less to complete. So not a very long process.
That's very helpful, Graham. And then what about in a situation where there maybe is like the low income earner
Mhm.
or the, just a spouse that doesn't have income is relying on spousal support or
Sure.
child support
Mhm.
um, as a source of income? Do they qualify for, for a mortgage loan? Or how do they
Yep.
qualify? When would they qualify?
That's a great question. So that's where the mortgage planning comes into play. And so
Mhm.
we would take a look at, are they working now? Are they planning on getting a job? What's that spousal support going to be, and how much are they going to be receiving? So the most important part about spousal support or child support is that you need to show that so after the settlement's completed, you've got to show that you have been receiving it for at least 6 months, and then it's going to continue for 36 months. So 6 months and continuation for 3 years. And it's the same with child support. So if you have a child that's 17 and you're getting child support, that income wouldn't be usable because it's not going to continue for 3 years. So, those are the two, I think, those are essentially that's the timeline for what it would take to do a loan. So, um,
That's helpful. And then what kind of documentation do you look for when you need to verify, the spousal support and the child support is coming in for, the 6 months of history and it's going to continue for 36 months going forward?
Yeah, absolutely. So we're going to look at the settlement agreement just to see what the terms are. And then really what we're looking for is a lot of times people want to try to commingle, they'll just, if those spouses don't end up taking, separating themselves off of their bank statements and they're just kind of sharing the money that's in the bank statement, you don't want to do that. Really, you're looking to separate yourself. So have your own bank account, have that money transferred from the ex-spouse, and then another thing that we see people that they make mistakes sometimes is like, let's say that the mortgage is in one of the spouse's name, and instead of giving the full uh, spousal support, they'll make a mortgage payment and then they'll give the spouse the remaining amount. We don't want to do that. We want to honor the terms that are on the settlement agreement for at least 6 months, have a separate bank account, and show that money coming in every single month at the full amount. Because if you don't, then you're leaving you're leaving a question for the underwriter who's doing the loan going to say, well, if they haven't paid the full amount, or if they've skipped a month, or they've paid the mortgage and not the full spousal support, they're looking for consistency for 6 months going forward.
That is very, very helpful guidance, Graham.
Yeah,
So can we next pivot a little and talk
sure.
about this thing called the contingent liability rule? Can
Hmm.
you share like what is it? What kind of
Yeah,
relief can it provide?
absolutely.
Where is it written?
Yeah, so this is a big deal. So Fannie Mae, Freddie Mac, the two, the main people that buy mortgages, kind of make up all the guidelines. Some jumbo lenders will accept those guidelines. So their guidelines say, and they call it a contingent liability or court order assignment of debt. So in the settlement agreement, you can assign the other spouse whatever you want. So it could be a car payment, it could be student loans, it could be credit cards, it could be the mortgage payment. So if that liability is assigned to somebody else, it's considered a contingent liability. So let's just take a quick example. If if the husband's name is on the mortgage, and the wife can't qualify to take over that mortgage, in the settlement agreement, it can say that the wife is now responsible for the full mortgage payment. And then going forward, if the husband wants to buy a new house, the lender looks at that as what's called a contingent liability or a court order assignment of debt. So they can't count that debt against the husband when he's going to purchase a new home. So that's a big thing to keep in mind. A lot of people just say, I need to get off this mortgage because I'm going to want to go do what I want to do and not have any issues qualifying. Well, if you have that contingent liability, doesn't matter what debt it is to include the mortgage, the new lender cannot count that against that person. So it can be an advantage in a situation where somebody can't, like the woman can't qualify at the time to refinance the house because her income isn't enough without the spousal support. So it's sort of, I don't say kicks the can down the road, but it's a good stopgap for the time being to help that other person, do what they want to do when the separation happens.
Yeah, it really provides a huge relief. That's very, very helpful, Graham. So really appreciate you walking us through it. And so this actually concludes today's episode of Empowered Divorce Decisions. Thank you, Graham, so much for spending some time with us, for sharing your expertise, and for shedding light on mortgage options and divorce. Yeah, well, there's a lot more to it. So if you have any questions, feel free to reach out. Absolutely. So you can reach out to Graham or myself if you have any questions. We'll include contact details both for Graham and myself in the video notes. Thank you, everyone, for watching. See you next time. See you guys.